What's up guys, it's Investors Guide here with our latest video, the best way to become rich, index funds. Please go leave a like and subscribe if you liked the video, and tune in next Sunday for our next video. Not everyone can master the stock market. Often the people who are able to outperform the market have years of experience along with several degrees in finance and economics. While you're unlikely to outperform the market by yourself, index funds provide you the opportunity to not only perform at the same rate as the stock market, but also to focus on specific sectors of the market. Index funds are bundles of other investments such as stocks or bonds. Index funds track the performance of the overall stock market or a specific sector of the market, such as technology or pharmaceuticals. These indexes are metrics that measure the value of a group of stocks over time. This way, when the index as a whole performs well, the value of the fund increases alongside it, which increases the value of your investment. The most obvious benefit of investing in index funds is that your portfolio becomes instantly diversified, which reduces your risk by spreading it out across hundreds of stocks. For instance, an index fund that tracks the S&P 500 has 500 different investments. The performance of these different stocks will vary and fluctuate over time, but when your money is spread out among so many assets, these ups and downs are smaller. If you put all your money in a couple of stocks and they both drop in value, you could lose your initial investment. But when you have 500 different investments, a single stock that loses value won't decimate your portfolio, as the 499 others are picking up the slack. An expense ratio is an annual fee that all mutual funds, including index funds, charge their shareholders, usually a percentage of the total assets you have invested. If you have $1,000 in a mutual fund with a 1% expense ratio, you pay $10 per year to own it. Actively managed mutual funds often have expense ratios between 1% and 2%, because portfolio managers are responsible for picking the investments in the mutual fund and are actively buying and selling at all times. Index funds, on the other hand, are passively managed. Due to their design of tracking an index, investments within the funds rarely change, so there's little work for portfolio managers to charge you for. Index funds pass these savings on to you in the form of lower expense ratios. Many charge somewhere between 0.05% and 0.07%, and some have expense ratios as low as 0.03%. If you invest $100,000 in a mutual fund with a 0.03 expense ratio, you will pay only $30 per year, versus the $1,000 you'd owe annually if you invested in a mutual fund with a 1% expense ratio. Index funds have a lower turnover ratio than actively managed funds. Turnover ratios measure the percentage of a mutual fund's holdings that are replaced in a single year. For example, if the fund has 100 stocks and 10 were swapped out for new ones this year, the turnover ratio would be 10%. If those assets were worth more when they're sold than when you bought them, the difference between the two prices is considered a capital gain, and you'll be taxed on the amount, costing you even more money. This isn't really much of a concern with index funds, though, thanks to their lower turnover ratio, with 1% to 2% per year, compared with up to 20% or higher for some actively managed funds. Only 23.51% of actively managed mutual funds outperform the S&P 500 over 5 years, according to the latest data from Standard & Poor's, and numerous other studies have supported this. Index funds have generally high returns and low costs, and make them an excellent value for investors trying to keep expenses low and profits high, which everyone should be. There are several main costs to consider when investing in an index fund. The first being an investment minimum, which requires you to put several $1,000s up front. But once you cross that threshold, most funds will allow you to invest smaller increments of money at a time. Another cost is an account minimum. This is different than the investment minimum. Although a brokerage account minimum may be as low as $0, common for customers who open up a traditional or Roth IRA, that does not remove the investment minimum from a particular index fund. As previously mentioned, expense ratios are one of the main costs of owning an index fund, as they are subtracted from shareholders' returns as a percentage of their overall investment. Find the ratio in the mutual fund's prospectus or when you call up a quote of a mutual fund on a financial site. For context, the average annual expense ratio was 0.09% for stock index funds and 0.07% for bond index funds, versus 0.82% for actively managed stock funds and 0.58% for actively managed bond funds, according to a 2016 report from the Investment Company Institute. The final main expense is the tax cost ratio. In addition to paying fees, owning the fund may trigger capital gains taxes if held outside tax-advantaged accounts like a 401k or an IRA. Like the expense ratio, these taxes can take a bite out of investment returns. Typically 0.3% of returns when invested in an index fund, according to a 2014 study by Vanguard founder John Bogle. Fund tracker Morningstar calculates the tax cost ratio, which shows the percentage by which a fund's performance has been reduced by taxes. Lastly, there are several risks associated with investing in index funds, with the first one being low flexibility. Since index funds are passively managed, the fund managers cannot buy and sell securities at their discretion to react to adverse market conditions. The second risk being a tracking error. If an index fund does not accurately track its benchmark index, the returns to the investor will be different than that of the benchmark. Final risk could be underperformance. Because of fees and expenses, an index may underperform its benchmark index. Typically, the index with the lowest expense ratios can more accurately track the index than similar ones with higher expense ratios. Hope you enjoyed the video. Don't forget to like and subscribe and tune in next week to catch our next video.